Welcome to this very special edition of The Firm, coming to you from the Reserve Bank of India headquarters in Mumbai. In just a few minutes from now, I'll be joined by a man who's about to put to rest all the confusion surrounding call and put options in this country. As you will recall, at the start of this year, the RBI issued a notification saying shares of convertible debentures containing an optionality clause but without any option or right to exit at an assured price shall be reckoned as eligible instruments to be issued to a person resident outside India by an Indian company. But there was a twist in that notification. The RBI has prescribed a new pricing regime for foreign investor exits using call and put options. And while it's not our case that equity should get assured returns, a dual pricing regime can be confusing and in some cases unfair. For instance, in the case of listed equity, a non-resident has to buy from a resident at not less than preferential allotment price. But when selling to a resident using an option, the applicable price is the market price. In the case of unlisted equity, a non-resident has to buy from a resident at a not less than DCF-based valuation. But when it comes to selling to the resident using an option, well, the price has to be arrived on the basis of return on equity in the latest audited balance sheet. Interestingly, for investments in preference shares and debentures, the entry pricing is specified, but the exit pricing can be as per any internationally accepted pricing methodology. So why has the RBI created a dual pricing mechanism? Joining me on this special edition is G. Padmanabhan, Executive Director, RBI. Mr. Padmanabhan, thank you very much for your time and thank you for speaking to the firm. Let me start by asking you why it was not enough for the RBI in its notification or circular to simply state that, look, we will not allow for an assured return. Why did you think it was necessary to impose a new set of pricing criteria, linked to whether it's listed equity or unlisted equity, creating a dual pricing mechanism of sorts?
Well, I think we thought about this for quite some time as to what we need to really put in there. I mean, whether we like it or not, one of the aspects that is happening both in respect of, mostly in respect of the FDI, is that the pricing gets notified by the government and the Reserve Bank of India. I mean, that has been the rule always. So at some stage to say that the assured return is not there, but you can put any kind of formula there, would have, again, we would be faced with a plethora of questions whether this is right, that is right, and we would be facing a number of questions. This has been our practice in the past. So we needed to be very clear as to we give one basic formula based on which the market will be able to take it forward. Having said that, let me also admit that probably the last line on this has still not been written. We want to see how this will impact, how the market will take this forward, and if there are operational difficulties still, let me place it on record that Reserve Bank would be willing to continuously look at it and improve the system. We looked for a better indicator, and from our discussions, the best indicator possible was this, where an assured return was not given.
All right, fair enough. And you've been very encouraging in saying that you're open to looking at any suggestions that come in. But when you said that you needed to put in a pricing requirement, because that's been the tradition at Reserve Bank of India, let me ask you this question. You already do have a pricing requirement. When it comes to both the entry and the exit of foreign investment in this country, you have put in a DCF floor for unlisted and a DCF cap for unlisted. Similarly, there are criteria for listed, and I won't list all of that right now. Why is it that that was not enough?
I think if you ask any finance guy, the discounted cash flow really cannot be considered as something where an assured return is not being given. In a way, yes, I agree with you. But the problem with the discounted cash flow is the final price depends upon what is the discount factor you put there. And the discount factor could be anything. So whether discounted cash flow is the ideal way of moving forward, in my personal view, probably not. So we had to give a number which probably gave less amount of freedom to interpret at what could be the discount factor, because the next set of problems we could be facing is that we would be faced with a number of questions about what could be the discount factor. How do we know that Please remember that we are talking a discounted cash flow basically takes into account the future prospects of the company also. The future prospects nobody knows. And as far as an equity investor is concerned, the difference between the debt investor and the equity investor is that the equity investor has to take the risk as far as the company's performance is concerned. And that is what we have tried to achieve by prescribing the return on equity.
There is no argument with the fact that, of course, an equity investor must take risk, and there is nothing like an assured return when you're using equity as an instrument of investment. But you have tacitly, in a sense, admitted that DCF is fudgeable. In that case, the shift from CCI pricing guidelines to DCF, which took place not very long ago, I think barely a year and a half or 2 years ago, in itself comes under scrutiny or under question.
There is a slight difference between, while I agree in substance with what you are saying, here we are talking about an agreement or a contract where the investee company is compulsorily forced to write this option. So this is where we wanted to give some kind of a better arrangement rather than the DCF. Now, if you ask personally what would be my take on the whole thing, I think progressively we should move towards a regime where neither Reserve Bank of India nor the government gets into the question of pricing, and the pricing is decided by the buyer and the seller.
If my audience is here, there would be a loud round of wild applause to that. But unfortunately, we're not there yet, right? Because we now have not just one pricing regime. That's been further compounded by the fact that you have this curious sentence which says at a price not exceeding that arrived on the basis of return on equity as per latest audited balance sheet. This applies to the exit of foreign investment by a foreign investor to an Indian company in unlisted shares. Now,
with an optionality clause.
With an optionality clause, of course. As per latest audited balance sheet, does it have to be the annual balance sheet?
No, we have not said so.
Quarterly or half yearly?
It could be anything. It could be it has to be an audited balance sheet. It could be anything.
Okay. And when you say arrived on the basis of return on equity?
Okay. Now, to explain that, I think we need to understand not merely the letter of the circular, but the spirit of the circular. Sure. The problem why the optionality was banned in the first place was that there was a problem between the money coming in through this route, which is really an ECB money, where an assured return is being taken. So we have tried to curb that, and we said the optionality is completely stopped. But then we also will have to realize that we live in a world where we'll have to compete with the rest of the world in receiving this money. So completely stopping optionality, if rest of the other countries permit this optionality, then there would have been a problem. So we wanted to have some kind of a via media where we ensure that an ECB does not come in through this route, which was primarily the concern why we stopped this, and finding out a via media. If it is understood in that spirit, then basically what we are saying that an annualized return on your equity with an optionality clause, if your return on equity, let us say for that year of the company is 15%, it can be anything between 0 and 15.
For that year?
Absolutely.
Now, if this is a 5 or a 7-year investment, which is typically how foreign venture capital investments work, and I'm using that subset because that's the subset that gets most impacted by this, right? Unlisted equity.
Absolutely.
Now, foreign venture capital works between a 5 to 7-year exit, and for them, if the last return for the last audited balance sheet, as you pointed out, is 8%, 12%, 15%, they earn 15% over a 5 or 7-year period, sir? We
agree, Menaka, that a 1-year money, the return has to be less than a 5-year money.
Yeah.
Obviously, right? So a person who has put in for 5-year money, we are saying that you calculate your return on an annualized basis for this 5 years based on your return on equity of the last year. So if the company has been improving on performance, take higher amount out. We have no problem.
So can you give me an illustration just so that this is crystal clear for everybody?
What I'm saying is that if the company's performance increases over the 5 years, starting from an 8% to 15%, we are saying that if the optionality says that 15% annualized for the 5 years, he can take it out.
So that's 15 into 5.
I mean, I'm not talking about the numbers. You get an annualized return. That's the technical way of putting it at the ROE basis as per the last audited balance.
Will this be capped?
by DCF in any fashion. So that's the other question that came up.
Please remember, we are dealing with two sets of contracts, or even in our view, two sets of instruments. One instrument which is a pure FDI instrument where there is no optionality built in. Here we are talking about an optionality built in. Again, I have again explained to you the background for this. And when an optionality is getting built in, that is based on only the provisions of this circular and not beyond this. So the DCF does not come into the picture at all.
So if you're exiting using an optionality, then there is no DCF cap that applies to you. That's the simple takeaway.
And even the other way around. If you're not exiting using this optionality, but this optionality was built in, you cannot force the investor. Then it becomes as if you cannot force the investor. You cannot have a contract there stating that I will have the right to say that either I will use the option or we will use the DCF method if I don't have the option. Then the purpose of issuing the circular is defeated.
So you can't arbitrage between the two is what you're saying. If the ROE based rate of return was not, or the ROE based price was not working out to the advantage of the foreign investor, and that could happen. Businesses go through ups and downs. One can't envisage every single situation in advance. Then can the foreign investor let the option be cancelled or lapse or etc. and choose to exit not via an option and thereby use the DCF valuation criteria as a cap?
Okay, let me try to probably edit my earlier answer and say that cannot be a part of the contract.
So I don't know how RBI will even check all of this, because how are you going to check what's written into a variety of these agreements? So where will you be able to monitor all of this?
Well,
anything can go.
Yeah,
right?
Can I answer that?
Yes.
I think Reserve Bank, honestly, this country will have to move towards believing that we would be facing a society which believes in compliance. So if the Reserve Bank has to police every contract that is written between the investor and the investing company, that is just not possible. So whatever cases that we got on based on which all these developments happen were those cases which came to us for compounding. Right. Because at some stage it got caught. They said it's not as per the FDI policy. That came to us for compounding, and that is where all these policy changes happened.
Fair enough. But there's one issue I think that's still bothering many people, and that this circular is not prospective.
If you had written an optionality before the circular was issued, after it was banned in 2007, that was not a valid contract at all. Because we said that's not an FDI compliant instrument. So what we have tried to do is actually an exit route. What we have said is that if there are any existing contracts, in fact, one of my lawyer friends talked to me when the government notification was issued, actually alerting me on this, that if you could give them some exit option of the existing contracts, as long as it is corrected to comply with these norms, then it would be a better way forward. In fact, we thought we had given an exit clause and the market should be happy about it.
Mr. Padmanabhan, I'd like to now come to the third instance, right? So there is the exit of listed equity, and we'll come to that later on in the show. The exit of unlisted equity, which you've spent quite a bit of time clarifying on how it will work. And then the exit of a foreign investor using an optionality via preference shares or debentures. And in that case, the RBI has given a considerable amount of, I would say, leeway or latitude to the investor to determine the price worked out as per any internationally accepted pricing methodology. The broad view is amongst most lawyers and investors that most foreign investors especially will prefer to come in via CCPS CCD and exit via CCPS CCD, because that gives them a lot more sort of latitude in determining pricing, as opposed to unlisted equity where you put in several restrictions.
Right. As I said, I think this is just one stage before we make all the instruments based on internationally accepted pricing norms. We wanted to address the issue of the FDI having these options unlisted company first separately, because there were a lot of problems with that. We have addressed that. We are in discussion with the government, obviously, to make this pricing guidelines uniform across. So it's a matter of time before this uniformity sets in. I agree that as of now there is a little difference between what is there for the CCDs and CCPS, but it's a matter of time, I hope, before we will be able to have uniform pricing guidelines across all instruments.
So you said you're in the process of unifying, so I just want to make sure you want to convert CCPS, CCD to ROE based as well, or you want to convert unlisted to internationally accepted pricing.
Please remember that Reserve Bank, the way forward, at least as far as the FEMA guidelines are concerned, is to liberalize. We don't go back to a more regimented or stricter kind of calculations or the formula. So these are two separate regimes as it exists today. You would also know that there is a lot of work taking place. Government and Reserve Bank of India are looking at revamping the entire FDI guidelines to make it simpler. So today the problem that has cropped up is these are two different regimes, and these two different regimes, as a result of which two separate pricing guidelines apply. So our idea is to make this all uniform as quickly as possible. The work is on. When that will be completed, I do not know, but it will be very quickly, I hope. But having said that, the specific answer to your question, that whether it will be more strict or liberal, it will be towards further liberalizing.
And I'm sure that will be applauded across the board, sir. But currently we've got a situation of product arbitrage.
Yeah, but there is product, the way in which the FEMA has worked and the markets have developed in this country, there is a product arbitrage in several other spheres as well. It is not relating to this particular circular.
Why? Is there a reason or a rationale?
The point that I am trying to tell you is that we recognize that this difference is there, and we are trying to work towards harmonization.
So, but and much as I want to believe you, for every single instrument there are multiple pricing situations. So I'll go to listed equity now, which we haven't discussed at all. All exits from listed equity seem to now require to be done on the stock exchange. That seems to be the first implication of this notification. Secondly, you have said that if they're done on the stock exchange, they have to be done at market price, obviously. But the entry into listed equity might also draw the preferential allotment pricing guidelines of SEBI.
It is not to be interpreted out of the circular that the listed shares, it has to be exited only through the stock exchange. We have not said that. We are here talking about only the pricing guidelines.
At the market price determined on the floor of the recognized stock exchange.
There is a price which is recognized,
and that price will have to be determined on the floor, then the only way to determine it on the floor of the stock exchange is to trade it on the stock exchange. So there's no other way to determine a market price on the floor of the stock exchange. You could have said at the last closing price or something like that. It doesn't say that. The language seems to imply that you want all of these transactions to be done on the floor of the stock exchange.
At least that was not the intentions when we were discussing this. If the circular gives that impression, we would look into this and see whether any clarification needs to be issued on that.
Okay, so that's one point. But with regards to, again, here too, the entry price methodology, valuation methodology, is different from the exit price valuation methodology. So my point is, for listed equity, there's duality. For unlisted equity, there's several different situations and scenarios. And for CCPS, CCD, there's product arbitrage. How does all of this reconcile with the RBI's position of let's simplify, let's liberalize, let's treat investors as adults?
Your question is perfectly valid. I'm not disputing the aspects that you have brought out in your question. The point that I'm trying to tell you is that this circular, the Reserve Bank of India through this circular has not attempted to completely rationalize the pricing guideline. That process is on, and very soon we would be coming out with whatever harmonization is possible to make things easier. The only thing that we attempted through this circular was to make sure that this optionality issue was taken care of.
Okay, fair enough, sir. But this brings me to, I think, a grouse that comes up every now and then when we deal with regulations issued or notifications issued by the Reserve Bank of India, and that is, why don't you put these drafts out for consultation?
Okay, the drafts out for consultation normally we do when there is a major policy change. But in this case, when we were trying to sort of sort out an issue which was there, if we had put out this as a consultative paper, then if we receive 100 different opinions, then the whole thing gets taken forward or delayed by another 6 months, 1 year. So the consultative thing can be done. This we thought was fair bit of consultation with the marketplace and the consultants, with the consultants who were involved in this, who came to us for compounding. The discussion happened, the discussions happened with the government, and there was a fair bit of agreement that this is a good way forward to start with. We have done it.
You said you were open to feedback from industry based on which you might consider changing some aspects of this. Would you consider doing away with all these different entry price valuation criteria, exit price valuation criteria, different for listed, different for unlisted, different for CCPS, different for CCD, and try and give us some uniformity?
Okay. I'll answer this question in two parts. One is, as far as the pricing guidelines uniform across the board is concerned, that is the principle on which we are working, and the sooner we are able to come to a solution about this, and that is something on which you please take it on board, that we will be putting out a consultative paper, because that's a major change. As far as the other aspect is concerned, we are completely open. As I said, this we thought was a better way forward. If the market thinks that there are alternate methods where the same, without assured return, the same result can be achieved, but that works in a much more professional and simpler manner, the industry can very well come back to us, and we are completely open to making any changes in this part of the circular.
Super. Thank you so much, sir. And you said that you were looking at harmonizing all pricing guidelines. You want to tell us the scope of that and what the timeline for that is?
Very soon. I mean, advanced discussions have happened. We are in discussions with various stakeholders involved. Let's hope.
So you're hoping to harmonize all pricing guidelines
We
across
are hoping,
all
we are
various
hoping to
different
harmonize
investment
the
routes?
pricing guidelines in such a way that there is complete, if not reasonable amount of freedom to the buyer and seller, and an external agency like the central bank or any other regulator or the government comes out with what has to be the pricing guideline.
Mr. Padmanabhan, Happy New Year to you as well. Thank you very much, sir, for this interview,
Thank
for
you,
your
yes,
time,
thank you very much.
and for your candor.
Thank you.